Okay, so you want to own a space company, build a rocket, launch satellites, put stuff into orbit that other people are desperate to get up there.
Internet from space, imaging from space, tourism, cargo, the whole frontier. It feels like the last truly open industry left. A handful of billionaires racing to plant flags in a market that barely existed 20 years ago.
That is the dream, and it is not entirely wrong. Here's what it doesn't tell you. You can build a working rocket, successfully reach orbit, and still go bankrupt in less than 2 years. Because in this business, physics is not actually the hard part. Cash flow is. Let's start with what it costs just to get a rocket off the ground.
SpaceX spent roughly $90 million developing Falcon 1, its first rocket, and around $390 million total to reach its first successful orbital launch in 2008, a process that took 6 years.
Rocket Lab spent about $100 million developing its small Electron rocket to reach orbit. On the larger end, SpaceX has now poured over $5 billion into Starship, with Elon Musk saying the full program could cost up to $10 billion before it's done. Government-built rockets make even the expensive private ones look cheap. NASA's Space Launch System cost around $24 billion to develop. Europe's Ariane 6 cost its member states $4.4 billion, and analysts have concluded the rocket will likely need permanent annual subsidies from the European Space Agency just to keep flying, because it can't compete commercially with SpaceX's prices. That's the first lesson of this industry. Even when governments build the rocket, they often can't make the business case close. Before any of that, you need a license. In the US, every launch requires FAA approval, covering everything from flight safety analysis to environmental review to public risk assessment, a process that can take years and add millions in legal and engineering costs before a single test flight happens.
And a modern space company needs a serious technical team from day one, meaning propulsion engineers, avionics specialists, and structural engineers, who often command $150,000 or more a year, plus the actual cost of an employee running roughly double that once you add benefits, equipment, and overhead.
Small launch startups commonly raise $50 to $200 million just to reach their first orbital attempt. And that's assuming nothing goes wrong along the way, which in this industry is rare. Now, the trap that sits underneath every launch company. Once your rocket actually works, you have to sell rides on it, and the price of a ride has been collapsing for a decade. A SpaceX Falcon 9 launch now costs around $67 million, working out to roughly $1,200 per pound to reach low Earth orbit. Compare that to NASA's retired space shuttle, which costs nearly $30,000 per pound in today's dollars. Reusability didn't just make SpaceX cheaper. It reset the price floor for the entire industry. Every competitor now has to price against Falcon 9, whether or not their own rocket is reusable, whether or not their own cost structure can survive at that price. This is the central problem. Your fixed development costs were calculated assuming a certain price per launch. If the market price collapses while you're still building, your entire business case can evaporate before you fly a single paying customer. Once you're flying, revenue comes from a few different directions. Dedicated launches, where a customer pays for the whole rocket, regardless of how much of the capacity they use, typically run tens of millions of dollars. Rideshare missions, where multiple small satellites split a single rocket, run closer to $6,000 per kilogram, a much cheaper option for smaller payloads that has opened the market to hundreds of new satellite operators who could never have justified a dedicated launch. Government contracts, particularly defense and national security launches, pay a premium over commercial rates and often come with multi-year guaranteed manifests, which is why every serious launch company chases them aggressively.
And increasingly, companies don't just sell launches, they build their own payloads. SpaceX's Starlink constellation generates recurring subscription revenue from internet service, using its own rockets essentially for free relative to what it would cost to buy launches from a competitor, which is one of the biggest structural advantages in the entire industry. If you can't build that kind of vertically integrated revenue stream, you are entirely dependent on other people needing to launch things on your schedule at your price. Here's the disaster case study, and it's one of the most instructive collapses in modern private industry. Virgin Orbit, founded by Richard Branson, built a genuinely novel approach to launch. Drop a rocket from a modified Boeing 747 mid-flight instead of launching from a pad. It worked. The company successfully reached orbit multiple times and completed 33 successful satellite launches. It went public via a SPAC deal in 2021 at a valuation of nearly $4 billion. Then, in January 2023, its first launch attempt from a brand new spaceport in Cornwall, England, failed due to a dislodged fuel filter. A very ordinary, very fixable kind of failure. But Virgin Orbit had been flying only about twice a year, nowhere near the cadence needed to cover its payroll and fixed costs, and had already dug what insiders described as a nearly billion-dollar hole. The SPAC deal itself had raised less than half of the expected $500 million due to investor redemptions, cutting the company's financial runway before it even started trading. Within weeks of the failed launch, Virgin Orbit paused operations, laid off 85% of its staff, and filed for Chapter 11 bankruptcy. Reports at the time estimated the company only needed about $200 million to stay afloat, a modest sum by aerospace standards. But Branson, who held a 75% stake, declined to fund it further. The entire company, including its Long Beach headquarters, its Mojave test facility, and the Cosmic Girl aircraft itself, was sold off in pieces for a combined total of just under $36 million. A company once valued at $3.7 billion, with a working orbit-proven rocket, was liquidated for about 1% of that valuation. The rocket worked. The business model didn't survive long enough to matter. Let's run the numbers on two scenarios for a small launch company. Optimistic case, you spend $150 million developing a small orbital rocket, reach your first successful launch within 5 years, and quickly ramp to a cadence of 1 launch per month at a rideshare competitive price. At even a modest $15 million average revenue per launch, 12 launches a year generates $180 million in annual revenue against operating costs, fuel, staff, insurance, and range fees of roughly $100 million, leaving a genuine $80 million annual margin that can pay down your original development cost within 2 years and fund the next generation vehicle. Realistic case, the same $150 million development budget balloons to $250 million after a test failure forces a redesign. Your first successful orbital launch slips 2 years behind schedule. And once you're flying, you can only secure enough customers for 4 launches a year instead of 12, because larger competitors are already booked years out, and rideshare missions are eating into your addressable market. Revenue drops to $60 million a year against fixed costs that don't shrink just because you're flying less, since staff, insurance, and facility costs are largely the same whether you launch 4 times or 12. That gap between fixed costs and thin, irregular revenue is exactly the trap that swallowed Virgin Orbit. And it's the single most common reason technically successful rocket companies still fail financially. So if you decide to own a space company, understand what you're actually buying. You're not buying a rocket. You're buying a bet that you can reach a launch cadence high enough to spread enormous fixed costs across enough paying customers before your capital runs out. in a market where the price per launch keeps falling, and the biggest player can subsidize itself with its own in-house demand.
Reaching orbit has never been the hard part for long. Staying in business long enough to make it profitable still is.